Welcome to Jeff Eisenberg's 6-minute, right-to-the-point video series. This is our premiere episode, and today we have Bill Clingen with Macro Wealth Integration. He is an asset protection advisor. And welcome to the show, Bill.
Thank you very much.
Good to have you. As you know, this series is all about information, and we plan to provide it to you in a 6-minute time frame. So, Bill, let's get right to it. I'm going to ask you some questions about insurance. How can I save money on my insurance premiums?
Well, first of all, a couple of things to realize. There is a fee that's charged anywhere from 4 to 6 to 8% on the premiums if you pay them anything except for annually. Annual premium payments is the most cost-effective way of saving on your insurance. It seems like a small amount of money, but over a 40, 50, 60-year period of time, with compounding, it represents a lot of money. So that would be the first piece of advice to give. Secondly, when it comes to auto insurance now, I don't work with auto insurance or homeowners or property and casualty. That's not my area of expertise. But one thing to keep in mind, of course, is to always increase the deductible. Why have a $250 deductible when $1,000 will save you significant dollars? And in doing so, make sure, though, that you have increased the liability to the maximum. A lot of people fail to realize that. Example I give, I had a neighbor that had a friend that bought their daughter a car for graduation. She was involved in a fatal car accident, and they lost their house because they failed to have maximum coverage and an umbrella policy to cover that expense above and beyond what the auto insurance would allow. So these are things to keep in mind, but increase deductibles, increase the liability with the savings. Of course, make sure that everything is put in order and you're paying it annually.
Now, the reality of it is most people are not going to get in a car accident or a major situation, so the higher the deductible, obviously the lower the premium. Makes sense, because if you're not going to be in an accident or plan on being in a unhealthy or in the hospital, chances are you're going to save quite a bit of money, correct?
Absolutely.
Okay, very good. Now, the next question I have for you is tied a little bit to what I do, mortgages, is what is mortgage insurance? Why don't you explain that to us?
Well, mortgage insurance is simply life insurance. People don't like to use the word life insurance. I don't know why, because you're going to die someday, so you might as well call it for what it is. Buying mortgage insurance through an institution outside of an insurance company tends to be not a good idea. And there's a couple of reasons why. First of all, if you buy it through a mortgage company, they're the middleman. They're not the insurance company, so the rates tend to be higher. Secondly, if you ever leave the house, you leave the protection behind in most cases. Very important you understand that, because there could come a day when you're uninsurable, and at that point have sold the house, moved to another house, and not have any insurance.
So the insurance, does this insurance follow the house when they sell it through the lender?
In most cases, in most cases. The other thing to keep in mind too is that as a house is paid off, typically the premium rates do not go down. It's simply a matter of keeping a premium. The value of the house is going down because you're paying it off, and you're paying in a premium for absolutely for no reason at all. Also very important to understand too is that when you have the insurance through a mortgage company, that you make sure that the policy is not in a situation where you're going to receive, or the beneficiary is going to be receiving the house. Many times a mortgage company will just simply give you the pink slip for the house and no money. So subsequently you can go bankrupt by owning a house because you have no money to pay for the property tax and all the other expenses incurred. Better off having money in your pocket, non-taxable death check in your pocket or your spouse's pocket, rather than having a house paid off.
Right, okay. Now that makes sense to me. Now how much, when people are looking for life insurance, how much do they need?
Well, what I do is this. After 30, almost 35 years now in the business, I don't play that game of figuring out how much you need. Rather, I have the actuary do that for us. And what I do is I apply for whatever amount that you qualify for. People have this idea that I'm making $100,000 a year and I can buy $5 million or $100 million of life insurance. You can't. There is a specific sum having to do with actuarial tables, occupation, income, health, that will allow you to qualify for the maximum amount of money. So I always go in and I ask the underwriter for the maximum. What does that do? That gets the person then to reconsider with their attorney, with their CPA, with myself and others in the family. And by the way, I'm a real believer in family meetings because a lot of people fail to do that. that they understand that the insurance is there and for what reason it's there for.
Interesting, okay. So we're getting close to the end here. I know it seems 6 minutes goes by awful fast.
Sure does.
But I think there's a lot of good information here, Bill, that you're giving us on insurance, and I know there's a lot more to it. I mean, the other part is, can, you know, my kids be my beneficiaries, and how can I help my parents protect their assets that they have? We'll get into that probably in a future meeting, but right now we've kind of run out of time. So, Bill, how would someone get in touch with you if they were interested in talking to you?
Couple of ways. First of all, my website is bill@mymwi.com. That's bill@mymwi.com. Or my office number is 661-255-3436, 661-255-3436.
Okay, we are out of time. Thank you, and we'll see you next time.